we've got people dialing in from Wellington. They're free of coronavirus. We don't have to worry about that.
They are. Yeah. No, we took on board Councillor Barker's suggestion that our carbon footprint could be reduced by having people dial in from Wellington. So we'll continue to do that.
Don't put it on the bill, really. No. So thank you for coming. You're going to spend a little time with us, about 10 minutes or so, just giving us an overview of the portfolio, the way you see the world, and perhaps a little bit of commentary on where we're likely to be in 3 to 6 months' time.
Guesses.
Next Friday would be good.
John, Karen and Ben Petro, John is our economist and strategist, and Ben Petro looks after fixed interest, which given the portfolio is 50% invested in fixed interest and cash, it's important that he's here too. They're dialing in, so they're going to give you a bit of colour around what we're seeing in the markets and in the economy at the moment. We're pretty much in the middle of what's going on, so every day is a little bit different at the moment, so that's where we're positioned. Brent, Greg and I look after the portfolio on a day-to-day basis, so maybe while we're waiting for those guys to dial in, we could let you know where the portfolio is positioned at the moment, and then these guys could sort of carry on from there. So as you know, the council decided that investment funds would be split in two between Jarden and Noosa. So we're managing half of those funds. They come to us in 3 bits. So firstly, what we call the Hawke's Bay Regional Council portfolio that we started managing in the summer of last summer, and have had a full year managing that. So that portfolio is close to a psycho benchmark, so pretty much fully invested. The 2 other portfolios, which are called the HBRIC and Hawke's Bay Regional Council Port, which came from funds from the partial sell down report, we've been managing those since mid-September of 2019. And so without sort of switching backwards and forwards between those portfolios, the first portfolio is pretty much fully invested. The second portfolio is in terms of our equity exposure is about half invested. And so to take you back to our process, what we have been doing through this period is investing over time. So our view on that, given our understanding of the psycho and the council's ability to take short-term risk and volatility, is that when we see asset values elevated, see them elevated against earnings, not necessarily against where bond rates are, but against earnings, we see a greater opportunity for volatility. And there's been a few experiences or examples of that, where Rio Tinto decided to have a look at their assets in the south, and energy generators in New Zealand sort of fell between 15 and 20%. So there's volatility. So the way that we've managed that risk is to invest over time. So the position of the overall portfolio at the moment, with all of the funds that we're managing for the council, is about 2/3 invested in cash and bonds and about 1/3 invested in equity. So to put some numbers around that, we have about $15 million to deploy in the markets from here. So the current situation at the moment, while we're not enjoying the world, continues to present opportunities for us to put money into investments, and gives us a chance to buy great businesses at cheaper prices. What's happened? Well, the portfolio as we're managing in terms of the whole amount, for the year to date is down 2.6%, so that's real money, that's a couple of $1 million, about $2.1 million. But potentially less dramatic as sort of fear, reports and watching big news we've seen, especially over the US, with sort of 7% that's the overall portfolio from the start of January down about 2.7%.
For the American, since the high, it's down 12. The American market from the high is down, which was the high was up around about 19. It's down about that's 16%.
So maybe I can hear John Karen on the line there. Maybe we can pass over to you, John, to make some comments.
Should be better.
Yeah, I think he's getting right. Can you hear now?
Can you hear us now, guys, on the phone?
Speak up.
Yes, we can.
Speak up, yay. Refresh the question, please. Would you be able to give us your view of markets and the economy at the moment? You take over.
Yes, certainly, Sam. Thanks for the opportunity to talk to you today. Shall I go ahead? Okay, great. So if we think back at the start of the year, things were looking pretty good for markets, particularly for equity markets. The outlook for the global economy was improving, with a bottoming in manufacturing activity, good employment growth, robust consumer activity, particularly in the world's largest economy, the US. The risk of an extended US-China trade war had subsided with an agreement between the two countries at the end of 2019. And many equity markets had reached all-time highs. However, what a difference several weeks can make. That was before the rapid spread of the coronavirus in China. Since then, global and local financial markets have experienced wild swings as uncertainty over the economic impacts of the virus have caused investors to move away from riskier assets to safer investments like US government bonds, the Japanese yen, gold, and the such like. Markets have become even rockier as the virus has taken hold and started increasing rapidly in countries outside of China. There's been huge declines in the global price of oil in recent days as well, which has also disconcerted investors. So since the spread of widespread knowledge of COVID-19 and the news of that broke, global equity markets have fallen over 15%, while interest rates on safe government bonds have plummeted. The interest rate on the benchmark US 10-year government bond is now down to 0.74%. That would have been unthinkable even about 6 to 4 weeks ago. So this is a decline of around 100 basis points in a very short period of time. And New Zealand hasn't been immune from the market turmoil either. Although our equities have not experienced swings of quite the same magnitude, our interest rates have also fallen considerably, with the interest rate on a local 10-year government bond slipping to 1.04%, having slipped below 1% at one stage. So it's understandable that investors are worried about the effects of the coronavirus. The measures needed to slow its spread are drastic, as the experiences of China, South Korea, Japan and now Italy have so far showed. However, if there are no widespread company insolvencies or sharp rises in unemployment, we believe the economic impacts will be temporary. Governments and central banks have critical roles in this regard, with fiscal support from governments that's by far the most important in our view. We therefore see the most likely scenario is that equity market volatility will subside over coming months as the worst coronavirus impacts pass. Now we're starting to see glimpses of that in China and South Korea as net infection rates, that's new infection rates after accounting for the deaths and recoveries from the infection, are starting to decline. And when this starts, and so we're starting to see China and Korea in particular starting getting back to business. So this is a process that other countries around the world will need to go through, in our view. And Italy's going through that at the moment, and it's highly likely that other large economies will too. Once this starts to happen, equities will then likely be supported by the fundamentals of low inflation, low interest rates, and reasonably healthy consumer spending. Interest rates will likely tick up again, but are unlikely to breach the rates experienced at the very start of the year. But stepping back from from recent developments, the recent move should be seen in the context of large gains in previous years. Global equity markets were up around 25% last year. With recent declines, the US equity market is only back to where it was around August last year, while the New Zealand market is back to where it was in November 2019. So recent developments are another reminder that equity markets can experience significant bouts of volatility and downward movements. For the US market, for example, based on past experience, we would expect intra-year falls in the equity market of at least 20%, around once every 4 years. And there have been 2 falls in US equities of over 20% since the end of the GFC in 2008. So this has been the price that investors have paid for receiving higher returns from this asset class. Now I'll leave Ben to talk more about interest rates in a minute, but we're likely to see interest rates stay lower for longer in the current environment due to a combination of low inflation and relatively low and steady economic growth, and a world demographic profile that has more of an inclination to save than spend. That's all from me. Unless there's any questions, I'll pass over to Ben for some updates on the fixed income market.
Are there any questions? Thank you. Okay, thank you. I'll keep it reasonably brief because John's given you a pretty good summary there of what's been happening. John has alluded to the movement in interest rates that we've seen. There's also been quite a big trading range which has been apparent in the last 4 weeks as well. We've seen the US 10-year range about 130 basis points. So the market has been incredibly volatile. This has impacted credit spreads. So what I mean by that is the perceived riskiness of individual companies. And you've seen their pricing wider in terms of them being able to raise funds from the market. New Zealand Bank senior bond spreads in the 5-year part of the curve have widened about 20 basis points. The 7-year triple B part of the yield curve has widened by about 30 basis points. But to put that in context, these spreads are still tighter than where they were last year. So we consider the New Zealand corporate market and borrowers accordingly to be in pretty good shape. They've been deleveraging over recent years. They've been borrowing for a longer period, so they don't have the refinancing risk coming up. And they've also diversified their funding sources, so they're not so reliant on bank funding. We are watching the offshore issuance of debt very closely. Over the last 10 days, there was a 6-day period of there being no issuance, so no one could raise any funds for their own balance sheet in the bond market. This is unprecedented, and it means that we are watching this very carefully because of a liquidity situation which may arise going forward. We don't see that likely, but it is something we're watching very closely. And as John's mentioned, it's very likely that central banks and governments will come to the party and provide support and liquidity to these borrowers should they need it. One part of the market which has remained reasonably attractive for New Zealand investors is our perennial friend, is the term deposit market. There is still very good opportunity there for investors, and we've been taking advantage of that. But we see this as a potential short-term phenomena, especially if the Reserve Bank looks to cut rates in the next few weeks. They have a meeting on the 25th of March. There is a range of calls within the market, ranging from a full 75 basis point cut to a 25 basis point cut. We're probably more of the view of a 50 basis point cut should the volatile conditions continue. Any questions?
Craig, Councillor Foss would like to ask you a question. Thanks very much. Could you just expand a little bit more on this small chart, the charts down the list of the liquidity issue that you mentioned, and what that might mean for the market, given what we saw in 2008 when the start of the going on?
Sure. I think that the main area to watch is probably the high yield market in the first instance. 12% of the high yield market in the US is energy focused or energy issuers. As John alluded to before, would be oil price, and particularly the impact that will have on the shale producers in the US. That's the primary area of concern, whether they can continue to fund through the banks and more unlikely the public markets, and that has an impact that will flow through to the regional banks in the US and potentially some of the larger banks as well. Sort of more mainstream, I think, is probably less of a concern. Mainstream issuers, there is, most of the balance sheets, or a lot of the balance sheets are in reasonably good shape, as I alluded to. So there's pockets of risk, which I think will, if things do dislocate, will be potentially disruptive on other parts of the market, and you'll see that flow through equity prices pretty quickly. It's all reasonably fresh news, given that the oil price devaluation has only occurred in the last 48 hours, so that there is, plenty to keep an eye on, and that's something that we'll be doing and watching it closely.
Anything else from anyone? We'll just keep boxing on. Yeah, so we're taking quite a time up, so effectively what we're continuing on a daily basis is sticking to our plan, which is to invest the balance of the portfolio over the next 2 quarters. We're having some flexibility, we'll be able to move a bit quicker on the balance of over the last 2 weeks as a consequence of that. But there's no change to the plan. We'll continue to invest over a period of time. I just wonder if you could just remind councillors as to your cash deposits range but you're saying that you actually haven't reached the midpoint of the ranges because that would comment. But how much cash have you got? How much cash are you intending to invest in equities that's available? Right, so we've got another 30 million which can be deployed into equity, which is into growth equity. So current property, that's in a range of actual cash, so we can take advantage of that during this afternoon. But we also have a range of term deposits which are maturing over a period of time. Situation was it was cash, there's some discipline about having some term deposits which maturing the next month or so, which is holding us back, investing some of that. We're finding that the term deposit rates are significantly higher than say the bond rate or the cash rate. So we're trying to get that real extra income that we get from it. So in this situation, it just so happens that you haven't invested the cash into equities as high less than 10 players. That's just a bit. So our plan has been, so we've got the funds on about the 15th of September, we've worked out, and our plan is to do that over 4 quarters. We're not sitting here telling you that we saw this coming, absolutely not. We're holding to a plan of this over a period of time, and the environment is what it was. We have no control over it. We don't know what will come next, so we're sticking to our plan. I'm really interested. First, I'd like to say that for Rex Graham here, I'm chair of the council. I just want to say that I am confident in you guys about what you're doing. I think you're doing a good job. You had a lot of good work. You had a lot of work. That was great. But I'm interested in the big picture too. So 12% of the US economy is in energy, and now the huge pressures. I did note that the values have dropped 50%. So what happens in a world economy if 50% of them go broke? And because the other question is got to, what if 12% is in energy, and this is the economy that if it has a cough, we all sneeze, what percentage of their economy is in financial services? So that below 12. A couple of questions there. So what happens first one? What happens if half the energy companies go broke? John,
yeah, sure. Sorry, just to clarify. Sorry. Just to clarify, the 12% number that Ben gave before wasn't 12% of the US economy. It was 12% of the high yield credit market. Yeah, which is different. The energy sector is nowhere near that amount as a percentage of the US economy. It contributes 0.1% of total US employment. So the direct impact of insolvencies in the energy sector isn't that significant for the US economy. But I think it would be the indirect impacts if there were severe stresses there. If there were significant defaults in the high yield market, for example, that would flow through to confidence in other highly indebted and riskier borrowers, and could potentially flow through to the balance sheets of some of the banks in the US. So that's one of the things that people are worried about in the current situation. Well, it's not a central scenario, and I think the oil price would have to stay down where it is at the moment for quite a considerable period of time before that risk materialise.
Rex, I think that's
So,
a good example of that we've had in 2008 is enormous pressure put on the financial sector, and we did have a huge amount of bankruptcies in that sector. In terms of how our portfolio behaves during that period, US equity markets halved, effectively. Massive stimulus was pumped into the system, so an investor with a portfolio similar to the one you hold, which is 50% in equities and 50% in cash or bonds, should expect that portfolio to be down about 25%, which is incredibly uncomfortable at the time. But that is what happens in equity markets. So as the council is a super long-term investor, you would expect, as it has happened, that over a period of time there will be a recovery. And so the market, what we see today in the US is about 400 times, or about 400% above where it was at the worst during that 2000-2001 global financial crisis.
It should also be stated that that portfolio would be down 25% on a fully invested position. So if you're sitting with a whole lot more in cash in fixed interest, then the effect is not going to be as big.
So, yeah, thanks. I have another question too. The virus set this off, but it's not the reason. The reason is confidence. People, it's interesting to go on the table and ask, has anyone made a decision based on this? And most of us have. Most of us travel decisions, but confidence is like someone said on American television, which I'm watching, is like it goes down an escalator and you've got to climb back up the stairs. So, the world is lacking confidence at the moment, and not buying and not doing things and not trading, that's for sure, and everyone's in the cruise boat industry. Do we think this is going to go on for a while? Or, everyone's saying it's quick recovery, but it's in everyone's interest to say quick recovery, but is that the reality?
So the reality is that we don't know. We don't know the future. So we rely heavily on a good process, thinking about what we've seen in the past and investing accordingly.
So in the past, is it down now about upstairs?
Yeah, and remembering that the council's investment portfolio is intergenerational, so going up the stairs is okay. That's fine. So those are the things that we focus on. The lack of confidence comes quickly when you've got elevated asset prices. That's been a view of ours. Asset prices have been high compared to earnings. And so, there's volatile moves that have been, we've seen that. So that's why we've stuck to the process and we're still over a period of time.
That's a good question to come down. But what about the movement down in the Jarden question about not understanding these things? We're talking about asset values, what about return? And to what extent are returns based on buying and selling within the asset class as opposed to the dividends that are given share that you may hold pay? So about equity portfolio values declined by 25% over the next period. If you get to its half, what's it going to mean for our returns that you're requiring of the management fund?
So the cycle calls for 4.5% in year one and then 5% thereafter. So we interpret that as being total return, which is a mix of dividend return plus capital gains. Because that, over a period of time, that capital gains will play quite a big role. That's right. And you're getting a good sense of volatility at the moment and how it plays out. 5% on average is on a longer period of time as opposed to a shorter period. So the portfolio that we've managed for the year, the first portfolio returned about 11% last year. And so far this year it's down about 4%. So that 5% target is a long-term target. Does that answer your question?
Yes, I mean, we really should be looking at a significantly reduced revenue return from these funds over the next 12 months.
Well, there's, the story that these guys are telling about where interest rates are going and likely to stay for a long period of time is going to be a challenging one for investors. If half the portfolio is yielding 1%, the second half needs to be doing a lot better. And that really is a challenge for all investors. Chris Lawrence, good question.
Refer to the Treasury report?
Sure.
So on page 247 under the Jarden portfolio, point number 2, it states, and noting that this was end of last year, New Zealand and global equities were the standout performers for the portfolio over the quarter, returning 10.4% and 9.1% respectively. International and New Zealand property were the two weakest asset classes, both declining by 1 to 2%. So taking that point in mind, where does that sit now, that statement? And can we forecast for changes in both those two types of investments in the next 6 months? So. Oh, sorry. Yeah, sorry. Do you want me to try and write it down here? Yeah, sorry, I thought you'd had this report. So it's basically saying that we were getting quite a high return for our equity, invested versus New Zealand international property. So how would that look now for the situation we're doing now?
Well, so we're right in the middle of this situation, so forecast at the moment actually moving is for problems. Yeah, it's, I can sit here and have a guess as to where the markets will go at the end of the year. I'm not sure that is going to get us out. But we would expect that there's going to be some sort of recovery. But trying to forecast where equity returns will be this year, especially at the moment, is very difficult.
But the position we're in now is those dynamics have changed in terms of the two types of investments.
Yes, I'm not sure. I think those were returns from last year. So the world's changed since then. But this is the thing, the world is forever changing. The commentary from last year is easy to write because you knew what happened. Looking forward, it's finally challenging to work that out. That's why we are heavily in the process. And we've got the side now that we know what the allocation for the portfolio needs to be. And so we invest with that now.
Sorry, through the chair, could you just comment on how that looks for us, what your views are?
I think it's, imminently you're looking at a drop in investment income from these portfolios. So fiscally, I think we're still in a strong position. We've got really well external borrowing. We've got strong reserves on the balance sheet. So I think we're in a good financial position sort of out of Australia. So I'm not sure whether you would make any recommendations around changes imminently to our cycle in terms of changing our approach. When we designed the cycle, we certainly had a long-term view, and we knew, I guess, at that time that financial markets do fluctuate, and there's uncertainty from time to time, so I'm not sure we're going to make knee-jerk reactions, but this is a significant movement in the market, so I'm happy to take advice from particularly people from Treasury and get some feedback from the fund managers around whether they propose any amendments to the cycle to take us through the next 6 to 12 months.
Yeah, so we wouldn't suggest any changes to the cycle in the next 6 to 12 months. The challenges that we need to think about are the environment where interest rates are very low for a very long time. The fund is generational, so it has a very long-term view, and so that would mean to sort of say it should have more growth assets, but we also have a year-to-year cash flow demand, and so we'll take on a lot of growth in the short term. You're having a good example of that right now, so that's a challenge to make those two things.
We're getting to move on, so look, thank you for that. I've just got a quick question before I just regards to the cycle and your recommendations. I understand that, and I note your comments from Jarden's in terms of the response to this request of outlook, is that you're considering our approach too conservative
in light of our objective long-term for those long-term holdings. So is it settings the asset classes that need to be achieved? Is there sufficient scope within the asset class settings to achieve the goals we want, or should in fact we be looking at a change to those settings, to those parameters? Is the range sufficient? My pick is that you've got too much in cash and you need to move into other asset classes. Is that your view?
Yeah, so our current situation is because of the way we're moving portfolio. So I put that to one side for a moment. Whether the side rate and 50% in income assets and 50% of growth assets is appropriate for an intergenerational fund, that needs to continue to be challenged a bit. The cost of that higher return should be paid for and taken away is volatility. So I think the current environment gives you an excellent opportunity to test how that sits with council in terms of what that cost is like. So again, coming back to the question, have you got sufficient flexibility in the asset classes that we've prescribed to do that, to do that without a change to the cycle? Yes, I think we do. I think the environment with super low interest rates means that growth assets will tend to do a bit better because the funds will continue to go to it. So there's usually a balance in these things. But I think that we're also acknowledging that this is still very early in investing for the council, and building that sophistication and complexity into our own period time is probably relevant as well.
Look, I think we do need to move. It's caught us before. Look, thank you very much for coming and seeing us. It's very useful to see you face to face and talk about something. So we'll see you again soon, no doubt.
Thank you. Thank you.
Yes, thank you for calling in, guys. I hope it's all well down there, and we can send the rain up anytime we like.
Will do. Okay, thank you. Bye.
Sure. Okay. Well, can I just have a quick move on that? We'll move that, Councillor Foster. Thank you. Second about this slow fast, but that's through. So I'm going to agenda item legislate.
What would you like to see?
17.
Move into public excluded.
Well, are we going to move public excluded and then back out into the others? Is that what we want to do, or do you want to keep a touch on those?
Over you, Chair, but I guess Councillor Foss does need to go. And does want
So
to
we've got a
involve
quarter of
in
an
the
hour.
decision.
I'd rather go to the least. I think it's the most important one left.
Say again?
It's the most important one left is the least.
So it's the only decision item we've got left.
Sure. So in
I'll
terms
move the
we can always find that.
Yep.
So we're going to go into public excluded. It's just that we need to come out of public excluded to consider. Yeah, but so it's okay. So can we go into public excluded?